Hello, everyone. Welcome to Wealth Creations with Gaitha. We're just going live on Facebook in just a minute. So then I'm just going to wait for a few people to come in and then we'll start the conversation. So welcome.
Thank you. Looking forward to the session, and you're looking very beautiful.
Oh, thank you. Welcome, Mondia.
Thank you.
I'll start recording in a minute.
Okay, I'm muting, don't worry.
All right. Welcome, Jackie, to Wealth Creations with Gaitha. Welcome, Mondia. I'm excited that you're here today so that we can have a very engaging conversation around investing during and after COVID. So we will just go ahead and wait for a few more people to stream in. It's just 6 o'clock right away. So we'll just take a few minutes. And once people come in, we will start this conversation. As you're coming in, please go ahead and just say or put a comment or a question so that I know that you can hear me if you're on Facebook. As you're coming in, please go ahead and just say or put a comment or a question so that I know that you can hear me if you're on Facebook. As you're coming in, please go ahead and just say or put a comment or a question so that I know that you're hear me on Facebook. And just questions so that I know that you're Hello, everyone. I see a few people streaming in, so we'll just take a few minutes before we start and we can have this wonderful conversation. Hello, everyone. I see a few people streaming, so we'll just take a few minutes before we start and we can have All right. If you're on Zoom, just when you come in, please put please be on mute so that way we do not have any background noise. And we'll just be starting in a few minutes the conversation about wealth. I see more people coming in on Facebook. So when you come in, just go ahead and put a comment or a question. So then I will be able to know that you can hear me. So as you come in, please go ahead and do that. And we will be starting in a few minutes this wealth conversation. All right. So, all right. Welcome. I see Caroline has logged in. Thank you for coming today, and welcome all of you to Wealth Creations with Gaitha, Wealth Conversation, with Gaitha. I'm Gaitha, and I run a company called Regal Africa, where we help our clients create wealth. And it has been during this crisis of COVID-19 where I've been getting very many questions, people asking, what do I do in this season? I'm worried. I don't know about the future. And yet I know I still need to create wealth. I need to be able to manage my wealth. What should I do? And that's the reason why I decided I can be able to have this conversation every Wednesday at 6 p.m. East African time, or even in the US, 8 a.m. Pacific Standard Time. And I can be able to last 2 episodes. Today is episode 3 of Wealth Conversations with Gaitha. So the first conversation we had was all about the wealth formula. And the wealth formula basically are 3 steps, whereby the first step is you have to have a wealthy mindset. The second step is making sure that you have a wealth plan. And the third step is to make sure that you start actualizing the wealth accumulation that you need to have. So it's just a 3-step process, and that's just all it is to creating wealth. But it's not as simple as I may put it. And a lot of people say, look, I have a wealthy mindset, why isn't it happening? And I always tell people it might not happen because really what it is it also takes time. Whatever plan you have will take time. Some people, it's just a simple thing whereby creating wealth for them is just maybe buying a house, a car, the usual thing that you hear. For example, in Kenya, you want to have, a 3-bedroom house, 2 cars, and, and a couple of plots somewhere. So that's easy to have. But if you're looking to actually create wealth and make sure that you have enough wealth that will be there for 4 generations to come, then it's not that easy. And so the steps that you need to take are actually a lot harder, but it can be done. And the reason we're having this conversation is really to discuss, how do I go ahead and do that? How do I go ahead and start that process of wealth creation? In episode 2, what we actually discussed about was really the MAP formula, the MAP formula. And the reason we discussed MAPE is we realized that you can actually focus on just creating wealth, but that is not enough. Creating wealth and focusing on money is not enough. Wealth plan is just part of what you need to look at holistically in your life, right? So the first thing about Maisha, MAPE is Maisha. You have to have a life plan. What kind of lifestyle do you want, right? Because the kind of lifestyle that you have or you want will determine how to create wealth and what steps that you need to take. The other thing is about afya, your health. If you're not healthy, and as you know right now with COVID, if you're not healthy, then there's no way that you can become wealthy sustainably, because you're going to use all that money to take care of your health, be physical health, spiritual health, emotional health, psychological health. Everything, you need to make sure that you're making a plan towards your mental health and everything around health. And so that was the second thing. And the third thing was really around money. And that is what I'm actually specialized about. I'm a former banker. So I'm always talking about money, 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 money. But I know money is not everything. And when you're creating wealth, that's just part of the puzzle. The third thing we talked about was actually elimu. The only way you can become wealthy is having the knowledge of wealth. And so if you have your MAPI Life formula and you follow that, I know that you will start on your journey to creating and managing wealth. And with that background, then I'll just go ahead and just start talking about investing. And so for all of you who have joined in, I want to thank you. I see here we have Nima on Facebook. Thank you. And I welcome you to Wealth Creations with Gaitha. I see Kari Govi. Thank you for joining in. I also see Anne Louise. I see Diana. Thank you for joining in. And I can't wait to have this interesting conversation about investing. So when someone asks me, what is investing or where should I start investing? I always start off by telling people, are you investing? What are you investing in? And the first thing people say when I'm investing, they either tell me, oh, I have an insurance policy, or I have a piece of land. And I always say there are different things around investing. And before I go into that, the first thing I want to say is I think what we need to realize as people is there's a difference between saving, investing, and insurance, right? So when you're talking about saving, which is usually the first step that I encourage everyone to have, saving is just putting money aside for a rainy day, right? Which just means that if something happens to you, instead of you going to get a loan or something, it's something that is easily accessible. And usually the recommended thing to have is at least 3 to 6 months of your monthly expenses. So for example, if you know your monthly expenses is 100,000 Kenya shillings, then you need to have at least 300 to 600,000 in an emergency fund where you can actually be able to access it when you need it, especially sometimes when there's a crisis. For example, right now with the COVID crisis, if you do not have an emergency fund, then it will be a challenge to actually maneuver this season. So you always want to start saving by having an emergency plan. And the first thing you want to do is actually put that, for example, in a money market account, which is both a savings and an investment tool. The reason I recommend a money market account is because you can easily access it. So if you put a request to withdraw money, it goes into your account within 2 to 3 days. And that was historically, but then now because of technology, there are some fund managers who can actually put it the same day or within 24 hours. So you can be able to access your savings anytime, but really what I try to tell people is whatever you put in your savings is just something liquid 3 to 6 months. After that, you need to start investing. And when you're looking to invest, there are different asset classes, but one of the things I really need to focus on today is to try and tell people there are different ways of investing, and the old historical way of buying just plots or real estate, there are more asset classes that I think you need to be aware of. So as before I go into the next session, if you have any questions, go ahead and just comment or put a question on the chat and I will be glad to answer that. All right, thank you for that. So in regards to investing, as I mentioned, there are different ways of investing. Sometimes you can invest directly or indirectly. Now, what is the difference? For example, I could actually go in and invest directly in the stock market myself, right? I can go in and I can buy shares of KCB Bank, I can go buy shares of Equity Bank or buy shares of Safaricom, or if, for example, in the US, you can buy shares of Apple, or depending wherever you are, you can actually go to the stock market and buy shares. So you're actually doing that directly. The other way you can do that is actually indirectly. You can actually work with a licensed fund manager who understands how investing is all about. They actually understand what are the best companies to invest in. And so they actually make a better informed decision than you are. So what you would do in this case, instead of you going directly to buy shares in the stock market, what you can actually do is you can actually go in and work with a fund manager and put money in an equity fund. What happens in an equity fund is that you're able to get different shares in one fund. So some shares might do well, some shares might not do well, but you are putting them all in one, I would say, in one box. And actually helps you because a fund manager, like I said, looks at this investment day in, day in. So when you're making a decision, should I invest? You have to ask yourself, am I knowledgeable to invest directly? Or do I need a professional who will do that for me and I invest indirectly? The second thing you need to look at or ask yourself is, do I want to be an active investor or do I want passive income, right? So you have active investments and you have passive investments, okay? So active investments just means you're constantly looking at the market and making decisions. And usually the person who does that, I usually see in, traders, people in the stock market, people in the Forex market, people who are constantly looking and actively trading. They're buying and selling different assets, be it commodities, be it gold, be it Forex. There are different things that they're buying constantly. And so they're actively looking at these investments. They're buying assets, they're selling assets. And usually this is good if you're very informed, if you understand the investment universe, if I may put it. That's when it makes sense to actually be an active investor because you have to be very aware. And usually if you do that, then like I said, you have to be very knowledgeable, otherwise you will make mistakes. The other thing you can do is you can actually have passive income. Now, what that just means, and in the case of the wealthy people, what they do is they make money in their sleep. So what happens is they actually give a money manager to manage their money for them, whether it's 1 million shillings, 10 million, 100 million, billion, it doesn't matter. What happens is they can actually take this money that they have and they put it in an investment vehicle, which is then managed by someone. And then what happens, depending on the type of asset class, which I will be mentioning later on the show, what happens is then that money just makes money for you, right? So that's how you want to be. For you to be wealthy, for you to reach to a point where you're saying, I don't have to wake up every day and go to work, or I don't have to actively look at the market every day to understand where to buy and sell these different asset classes. I can actually be a passive investor and get things done. One of the things I also like telling people is, for me, because I'm a banker by profession, I understand how banks make money. But sometimes I actually looked at it and said, you know what, instead of me owning my own bank one day, why don't I just invest in already an existing bank that is making good money? So the person who actually has the person who has sleepless nights is actually the CEO of that bank. But if I have enough shares, I can actually get the great returns that a bank will make without me necessarily being actively managing that bank. So when you're looking at investing, you have to ask yourself, do I want to be a passive investor where I actually give that control to someone to invest for me? Or do I want to be active and I constantly be looking at the market? So that's another thing you want to look at when you're thinking about invest. Third thing, when you're looking about investing, you have to ask yourself, do I only want to invest locally, which is what we call onshore investing? So for example, if you're in the US market, then you'll only be investing in assets which are in the US. Or if you're in the Kenyan market, you only invest in assets in the Kenyan market. If you're in the UK, the same thing. So you're basically only investing in assets locally. And that's what is called onshore investments. That's what most people do, because most people invest in what they can see or what they know, which is actually a good strategy, because I always tell people you don't want to invest in something that you do not know. But the same token, you also have to be aware of the opportunities globally, right? So you don't want to miss out on investing outside your country or outside things that you don't know because you are scared, right? So you want to be able to say, I want to have onshore investments, and sometimes it's a good idea to do offshore investments. Personally, when I talk to my clients, I always tell them maximum you want to have offshore investments is 30%, right? You want to have investments in something that you know, something that you understand. And so if you're going to take that risk, what you want to do is at least put some of that aside, but not more than 30%. And most wealth advisors will tell you that, depending, of course, everything depends on a person's situation, but that is usually what most people are recommended. 70% onshore and 30% offshore. So now when you've actually reached this point where you've decided, okay, I want to invest directly or indirectly, maybe I want to be an active investor or passive, or you have decided how you're going to manage your money, either onshore or offshore, you really have to look at three things. In investing, the first thing you have to ask yourself is, how much money do I want to invest, right? The amount of money you can invest determines the kind of assets that you can invest in, right? There's some investments where you can start off with as little as 1,000 shillings. Even the stock market, with as little as 100 shares you can buy. But there are certain asset classes that you need a lot more money than just the usual. So what I usually tell people to do, the first thing you want to look at is to say, how much money can I invest? The second thing you want to look at is, what's my time horizon, right? So when you're investing, you have to ask yourself, am I investing short term, which is usually less than 12 months? Am I investing for the midterm, so anything less than 5 years? Or am I investing for the long term? Whenever you're investing, you want to think long term. You want to put money aside that you're not planning to use in the next 5 years plus. That is actually when you're saying you're investing. Anything less than that, and you want to access that, is still investing, but you might not get as good as a return than if you're actually having a long-term strategy. So when you're investing, you have to be very clear. What is my time horizon for this amount of money that I'm putting aside? And then the third thing is your risk tolerance. This is really, really important because some people are saying, I want really good returns, but they do not want to take a risk, right? They're very conservative. They do not want to lose money. And that is something that can happen, right? So you can't say, I want really high returns and no risk, right? No risk, no return is what I always tell people. If you want something risk-free, like government bonds, there's a certain return you will get. But if you actually decide, okay, I'm willing to take the risk because, for example, I am young, I have time to recover in the market, then now you're willing to take a risk, and then now you can go to different asset classes that can make you a lot of money, but also you can lose money, right? So for example, if you're looking in the stock market right now in Kenya, the returns have been going up and down because of what's going on with this COVID. A lot of people are not sure. Some people are saying it's a buyer's market. Some people are saying, you know what, I've gotten enough returns. I want to sell my shares right now and then actualize my return. So there's a lot of volatility, right? Be it also in the forex market, you know, with the dollar, what's going on? Is it strengthening? Is it weakening? What's going on? So there are people who are actually looking in these markets and saying, you know what, I am willing to take a risk that I might lose money, but I'm also willing to take the risk. I'm also willing to take a risk and make a lot of money. So when you're looking to invest, you have to be very clear. Am I willing to take a risk or not? Because once you're clear, then the financial advisor or the wealth advisor that you're working with will be able to advise you on what asset classes that you can invest, right? So remember, before you invest, you have to understand the amount of money, you have to understand the time horizon, and you also have to understand your risk tolerance. Now, what I have seen, and I want you guys to all take note of what's happening, especially now because we're seeing technology taking over. This probably would not have happened, you know, a couple months ago, because most people, when they were talking or when we were doing advising, was always face-to-face or one-on-one. So things are changing because of our new normal. So we are going to see the use of technology more and more, and that will affect the investment world. So the future of investing, especially retail investing, you're going to start seeing a lot more of what I call robo advisors, which means that there will be technology that would be able to advise you that this is the amount of money that you have, and we will manage your money based on the three things I mentioned to you: the amount of money, the risk tolerance, and the time horizon. So you're going to start seeing robo advisors coming in. The second thing you're going to see is actually what are called financial marketplaces, which is something that we've been working on at Regal Africa, the company that I founded, which just means you'll be able to go online to one place and be able to see all the opportunities and all the different asset classes in one place. The reason a lot of people have not gotten really good returns before, have not been able to create wealth, is because it's very opaque. Very few people know where to invest, and you need to know who to talk to be able to share this opportunity. But then now things are changing where things will be more transparent. You'll be able to compare one fund manager to another. You'll be able to compare one stock from another. You'll be able to compare, you know, online, you know, this property versus this property. You'll be able to actually have all this information online that will make you now make more informed decisions. And the reason I'm telling you this is because when you are looking to create wealth, when you're investing, you have to make the informed decisions. And earlier I mentioned you can either do that yourself by being knowledgeable, researching, understanding. But of course, if you're not an investment expert, the best thing you can do is actually go to a professional who can then advise you according smartly around that. So that is the future of investing. Let me see this. I think I have about 6 more minutes and then I'll start answering some questions. But if you have any questions, just go ahead and write them down on Facebook, or if you're on Zoom, go ahead and put them on the chat and I will be sure to answer those questions. Now, one of the things I'm always asked about investing, okay, I have this money, where should I invest? And I always tell people, when you're investing, the thing you need to realize is you need to have a diversified portfolio. It's not just putting money in one asset class. It's not putting money all in real estate or all in the stock market or all in bonds. When you're investing, you have to have a diversified portfolio of different asset classes. And the reason about this is because different asset classes have different risks. And so you want to mitigate this risk. When you're investing, it's all about risk management. So you have to realize that. So when you're investing, it's not about putting everything under one bucket. You want to make sure that you diversify your portfolio. And when you invest in, before you start really investing and knowing where to put it, like I said, you actually have to speak to different financial advisors and understand all these different asset classes. But the key here is really returns. Of course, everyone is investing to make really good returns, but there's no investor I know in the world who has not lost money. Everybody makes money and loses money. The thing about it is you need to gain more than you lose. So if you're looking to actually get really good returns, you have to take a risk. And there are what are considered real risks and perceived risks. So you have to look and say, look, is this something that I understand and it's risky and I understand it, or do I actually speak to a professional who can actually work the numbers based on the facts that they know? They can actually inform me better. So you have to be aware that there are real risks and perceived risks. Because what I have seen a lot of people who invest, they're always investing emotionally, right? So everybody is buying land in Nyanyuki. Let me go to Nyanyuki, right? Everybody is investing in the stock market. Let me go to invest in the stock market. And when you invest emotionally because you either like something or you had something or someone wealthy, Warren Buffett invested in this stock market, so let me buy. When you do that, the chances of you succeeding in the long run are not great. It's not a sustainable investment strategy because you really are not taking into consideration the data, the numbers. So when you're investing, the only time you can actually make money sustainably is really understanding the underlying assets and what are the facts about it. Really, if I'm going to invest in Apple, for example, right? Do I see Apple really growing in value? The valuation is increasing, and that's why the share price is going to go up because they're coming up with a new technology? Or am I investing in Apple because I like their product? Well, you might like their products, but nobody else likes them. So then the share price will not go up because then they're not making money and the valuation is down. So you have to really look and say, based on the numbers and the true numbers, is this a good investment or is it not a good investment? So be aware when you're investing real risks and perceived risks. And make sure when you're investing, you're not investing emotionally. You're investing based on the data and the numbers that you know. What are the trends? What do you foresee happening in the future? So that's one of the things that you really need to look at when you're looking to invest. Now, some people say, look, I do not want to invest. What I'm going to do, I'm just going to save. I'm going to save my money in the bank. I'm going to save my money in a circle and put it in my mattress. I do not want to lose money. And what I usually tell people, by you not investing, what is happening is you're actually losing money. If you're not investing and you're not getting a return in your money because you put your money in a current account or you put your money under the bed in the mattress, you're actually losing money because of what is considered what is known as inflation, right? So if you have 10 million shillings today and you put it into a bank account, right, at NCPA, and don't touch that money for 10 years. In 10 years, that 10 million will be 10 million. But what you can do with that 10 million in 10 years is not what you can do here today. So you have to be very careful by realizing by you not taking a risk to invest, you're actually losing money. You're actually losing money. So if you're not sure and you don't want to take such a high risk, then there are actually options out there that can actually mitigate those risks, but make sure that you are getting a return higher than inflation. And so this is where I'm now going to talk about just what the different asset classes are. There are many, but I'll just talk about the main ones that we know and what you need to be looking at. So when you're looking at investing or different asset classes, there are what are called traditional assets, and then there are alternative assets. So in traditional assets is basically you're buying a share in the public market, in the stock market. You buy a share of a company. That's traditional investing. Or you go in and you want to acquire a bond, be it a government bond or corporate bond. That's traditional investing. Savings stroke investing, you can put your money in a fixed deposit at a bank, savings at a bank. That's traditional. Everybody does that, and there are pros and cons about investing. But then now the opportunity, and what I want you guys to hear, the opportunity of the future is really the alternative investments. But you want to start off with, of course, traditional. And of course, you want to start off with, as I earlier mentioned, a few things, like you want to put money, for example, in a money market for an emergency fund. Then you put a few, start your portfolio with, stocks, bonds, cash at the bank, just little. But as you continue growing your wealth, you're making more and more money. Then now you want to go into alternative investments. Alternative investments is just anything outside the traditional asset classes. The opportunity that I definitely see in the future in regards to alternative investments, I do see them in three things. And of course, there are more opportunities. But what I'm trying to tell people is, in Africa specifically, the returns that will be seen are in agribusiness. And I'm not talking about the agribusiness of whereby you have an acre somewhere, a quarter, and you're just growing onions and you don't know where you're going to sell them, or you send them to Marikiti. No, I'm talking about investing in agribusiness, commercial agribusiness. Now that means that you cannot do it alone. You cannot do it alone. You actually have to either do it as a group, or you have to take your money and put it in a fund where a professional money manager is investing in agribusiness. But the reason I'm bringing this up is I'd like people to be aware that this is coming. So as you continue looking for opportunities in investments, you want to be able to realize that, the money is in this sector, in this case, like I said, agribusiness, but it's not the old way of doing it. So then when opportunity presents itself, then now you can actually look at it and say, do I partake of this investment or not? Now, agribusiness is great, but also very risky. Remember earlier I mentioned no risk, no return, right? Even with that, with most people who've done farming, because agribusiness is not only just the production, it's also the value addition, it's the whole value chain of agribusiness. But even in the production side, it's very risky because you can do everything. You can have the right seeds, you can do the right managing of the farm, you can actually have a contract to someone, but something can happen, weather issues, things can happen and you lose. If, for example, you are farming, vegetables or fruits, you can lose them, or, flowers. Or if you're in dairy, or if you're selling cows, or even in fishery, a disease can happen. So those things are very, very risky. But if you do it well, then you get good returns. The thing about investing commercially, either as a group of people or investing in a fund, the thing that happens is, in this case, you can actually get things like insurance that would mitigate this loss. So as as that group is investing or that fund is investing, they take into consideration some of the expenses that they will take to make sure that even if they're not able to get the returns that they got, you will still make money because you already have something that is some risk mitigation ability. So you really want to look at agribusiness. The second thing you want to look at is real estate. We all know, especially, for example, if you're in Kenya, that we all need housing. Housing deficit is a big issue. But what we have seen historically, people have been investing in, the suburbs, whereby the type of housing or the type of real estate that has been done is not affordable for the masses. So the opportunity that I see that when you're looking at investing, will be investing in the mass market, or at least affordable housing or affordable luxury, something whereby majority of the people can afford. Now, there are different ways of doing that. You can invest either as a group or as a fund, a real estate fund, whereby you're investing in something that is being done in mass. That is where you'll be able to get good returns. Before, people were always investing in a unit. Say, for example, you buy an apartment, just one apartment, or one office block. You still get returns, but not as good as before, because what we're saying is people are saying, you know what, I can make more money. I don't want to wait until this property is developed for me to start making, to start getting a good return, because people are realizing cash is king. Cash is king. And a lot of people have been putting money to developers who are not actually, what's this called again? They are not actually keeping their side of the bargain. They're not developing these properties as they say. So the way people will be approaching real estate investment will be different. So I'm actually encouraging people that you either come in collectively as trusted people to invest in real estate, or find a real estate fund, not a developer, but a real estate fund where you can put your money into that fund and professionals can actually manage the running of this real estate. So that's the second opportunity in regards to alternative investments. The third thing is actually business funding. This is the opportunity that is going to, the money that is made in lending by investors in this country, in Kenya specifically, is enormous, right? People are making 5-10% per month, which is over 100% a year, right? I always tell people, when you're looking at, there's this rule. Every wealthy person knows about this rule. It's called the banker's rule, which is by you actually are able to double your money within a certain time frame, right? And you always do that by dividing by 72. So for example, if I want to double my money within 2 years, then I would say 72 divided by 2, which is 30. So I need to make 36% per annum in order for me to double my money within 2 years. Now, can you imagine people are actually making 100% per annum? So basically, they're doubling their money before 1 year happens. But of course, this is really risky, because you can actually fund a business that will not be able to pay you. So even when you're looking at business funding, you want to start looking at, how do I mitigate this risk? Do I put this money with a fund that knows how to handle that, rather than me doing it? So the future I am seeing of investing in these alternative investments is when they're done really well with professionals versus someone doing it themselves. Because if you do it yourself directly, remember I was talking about directly or indirectly, if you do it directly, sometimes you will not be able to figure out the best way to manage all these risks that happen with that. But you have to be on the lookout. Business funding is really big. So basically, you become your own mini bank, right? People will be coming to you to fund, but remember, there is a risk of default. So even when you are trying to price out the return, the funding interest rate, you want to look at that. But also CBK in Kenya, for example, the Central Bank of Kenya is coming up, whereby these lenders who are not regulated, there are going to be issues around that. So even though they say this is an opportunity, it is still something that you want to be on the lookout for, because regulations will affect investing. when you're investing, you have to be aware about everything that's happening locally and everything that's happening globally, because it's going to affect your investment. But at the end of it all, you have to remember, am I going to invest in a traditional asset class? Am I going to invest in an alternative asset class? Or am I going to make sure that I have a diversified pool of assets so that I can be able to mitigate my risk and get the best returns out there? But it all depends on how much money that you have. Because, for example, if you have $1,000,000 or 10,000, you can't do too much diversification, right? Because then you're stretching yourself too thin. But the more money you make, the more you're able to diversify your portfolio and get really good returns. And with that, I guess I will just go ahead and start answering some questions, because I know I've said a lot different asset classes, what you should be looking at, and I will be glad to do that. So if you are on Zoom, go ahead and just write a question on the chat and I'll be glad to answer. And if you're on Facebook, I see a few people on Facebook here. Okay. So I see, I see more people joined in. What do you think are investment areas that will provide adequate diversity? In my case, I have a Roth IRA and a real estate option through crowdfunding. Could you make some suggestions? Okay. Wow, so it looks like Anne Louise, she's in the US. Right, because she's talking about a Roth IRA. So in Kenya, that's basically a pension, right? But in the US, they call them the Roth IRAs. Those are just individual retirement accounts. In Kenya, you can get personal pension. So the question is, what do I do to diversify? So for me, what I would advise you, Anne Louise, that Roth IRA is specifically for retirement, right? So you're looking at really good, because Roth IRAs are usually for people who are not employed, or their employer doesn't offer that. So I'm really happy that you're already thinking about retirement, because most people don't think about saving and investing for retirement. So that's a great thing. And then there's real estate options. Real estate is really good. I studied real estate, understand real estate, but you want to get into real estate which is generating you cash flow, right? So yes, you can start off by buying, one piece of land, 2 pieces of land, but more than that, you need to start thinking, how do I generate cash flow from this real estate that I have? And you're talking about crowdfunding is really good, because you also get really good returns, and usually it's managed by a particular company. Crowdfunding is basically chama in Kenya. I always say the same thing, because you're basically taking different people's money, putting it together, and then now somebody can actually borrow or and use it to do either business or do whatever it is that they need to do. So those are 3 things that you do. Could you make some suggestions? I already talked about the different asset classes. So in order for me to suggest something specifically for you, I would really need to understand what I mentioned earlier, the amount of money you want to invest. Are you investing periodically? Do you have a lump sum that you want to invest? I'd really need to also understand your risk tolerance. I'd also need to understand what your time horizon is. Is this money you're trying to put aside, is it for retirement, or is it for 5 years or 3 years? That's when I can actually, this is the way to go. So what I would advise you to do is actually speak to a financial advisor or wealth advisor to actually tell you exactly what you need to do. I hope I answered you, Anne Louise, but if you have any questions, just reach us out at wealth@regalafrica.co.ke, and I'll be able to answer it more in detail. All right, I do see here Rhoda. She's asking, hi, I did investment offshore some time back and I lost $1 million. How does one check to be sure that this is the right place to put your money? She invested offshore, she lost $1 million. How does one check to be sure this is the right place to put your money? That's a really good question, because I've seen a lot of people lose money, big offshore or onshore, right? There was a time a couple of years ago, and I think it was about 7 to 10 years ago in Kenya, there was this whole craze and everyone was putting money offshore. What I found out is a lot of people were not doing due diligence on the companies they were investing. Also, a lot of these offshore investments were actually insurance-backed real estate. I mean, sorry, not real estate, investments, which meant there were certain things or clauses that you really needed to be aware of. One is that where they're investing is risky, right? And there's also a time issue. If you withdraw your money before a certain time, then you lose your money. Also, where they're investing is also very risky, so then you have the ability to lose your money. So there was no guaranteed of the return that you invest in offshore. So for anyone who's investing offshore, I want to say these things. One, you have to know who you're investing in. So you have to have a track record of who that investment manager is. You also don't want to put all your money offshore. I mentioned that earlier, it's always advisable no more than 30% of the investment. And you also have to understand, is this a direct investment or is it an insurance-backed investment? So the devil is in the details. So you have to be very sure about that. And also, the reason why I am a wealth advisor as opposed to selling products is because sometimes the person who's offering you this opportunity is someone who's actually selling you that investment so that they make money. There's nothing wrong with that. But if that is the only reason why they're telling you to acquire that asset, then there's something wrong with that. So just make sure who that advisor is. Make sure you do due diligence on the investment company, and that will ensure that next time you don't lose all your money, and you're just aware about the risks in the investment that you're taking. I wish you well, Rhoda, and if you have any questions, then you can always reach out to us at Regal Africa. I'll be glad to answer you directly. All right. We have Jerome says, I wish to understand taxation on the various investments, land, apartments, unit trusts, stocks. Okay. All right. So understand taxation. Whenever it comes to taxation, I always tell people you want to speak directly with a tax advisor who would advise you, but I'm familiar with this, so I'll answer some of these questions. But before you make a decision, speak to a tax advisor. Tax depends on your jurisdiction. So if you're in Kenya versus if you're in Australia, South Africa, Nigeria, US, it's all different, right? So you have to be very aware that the tax depends on the jurisdiction or the place that that investment in. I will talk in this case about Kenya. For example, if you are looking at land, there are different taxes that are land, capital gains tax that the government has been coming up with. So you have to be aware about that. And land and apartments is the same. They put it out category as real estate. If you're looking at unit trust is usually a 15% withholding tax. The government makes money out of every money you make, right? So any interest that you make, any income you make, the government tax you. Now, of course, if you had a salary, the government usually tax you 30%, and now in Kenya it's gone down to 25%. But if it's an investment, they don't tax you that much, they tax you just 15%. And the same thing with stocks. Stocks are considered capital gains. So for example, you bought a share at 100 and now it's gone to 150. The amount you will be taxed is based on what you gain. The difference between 100 and 150, which is the 50 shillings, that's what you're going to be taxed on. But at the end of it all, you want to make sure that you speak to a tax advisor who advises you accordingly on each thing that you're doing. And as I mentioned before, I am a wealth advisor, but not a tax advisor, although I am familiar with some of these things. The best thing that I always tell people to do is while you're investing or when you're looking at your wealth plan, you have to put it together. You have to understand your whole financial picture. In fact, at Regal Africa, we just came up with a wealth book, which is something that we've been working with our clients over the years, which is basically understanding where you are and gives you the information about your tax planning, your retirement planning, estate planning, pension planning. So the first thing you want to do, you either sit down with a wealth advisor or you can actually purchase this workbook whereby you write it down. So by the time you're talking to a tax advisor, you're telling them, this is the situation that I'm in. Can you advise me accordingly? All right. We still have about 10 more minutes to go before we finish these conversations with Gaitha. So if you have any questions, just go ahead and write them down either on the on the comments or on the chat box, and I'll be glad to answer that for you. All right, so I do see here Miriam is asking, hey, for those of us who came in a little late and missed on the part of insurance covered investment, would you mind just passing through that again real quick? Okay. All right, Miriam. So earlier I mentioned the difference between saving, investing, and insurance. Saving, investing, and insurance. Saving means you're just putting money aside. It's really thinking about emergency fund. It's very liquid. You can access it anytime. It's just that that you need to be able to access it, and you don't make a lot of money out of savings. Now, when you look at investing, the best strategy for investing is really thinking long term, right? You want to make sure that you are thinking, okay, where do I put in this amount of money, and what kind of return will I make in 5 years, 10 years, 15, 20 years? You're thinking long term. I know that seems like a long time, but that's the mentality you need to have when you're thinking about investing. Even though you can still invest short term in money market funds, mid term in bond funds or balance funds or equity funds, you can still do that, but you want to think long term in investing. When you're talking about insurance is very different. Insurance is about protecting, right? Insurance is a risk management tool, means that you're putting money. So for example, an insurance company will say you're investing for your child's education, right? So you're putting money aside, a certain amount of money every month, 50,000, 50,000. And then after 10 years, you'll have a chunk of money given to you. The thing about it is what the insurance company is doing is saying, if something happens to you, for example, you pass away based on your policy, and maybe it's in the second year, you're going to get all the money that you'd have gotten within that 10-year period, right? So if it's, I'll just use 10,000. 10,000 means, 120,000 every year. So at the end of the year, at the end of 2 years, you'd have put aside 240. But if your policy was for 1 million shillings, you get 1 million. Versus if you're investing and you're putting 10,000 every month, you'd only get that 240,000. Plus the interest that you've earned. So the difference between insurance investments and regular investment is just that the insurance policy has their conditions there according to the policy, which means you'll get this money if something happens. Either you pass away, if it's a life policy, if it's an education policy, it's the time that you've put the money for. So when you're looking at insurance products, like the lady who talked earlier about offshore investments, they're mostly insurance-backed products. You have to understand the difference. And usually if you remove your money before that period, there's usually a penalty, you lose some money. So you also want to be aware about that. So when you're actually doing your wealth plan and you're looking at diversifying your investments and how your wealth looks like, you want to look at investments, and then you also want to look at some options in insurance. I hope, Miriam, I was able to answer that question for you. All right. Then I do have here Stella. Which is the best investment for Chalmers? Oh wow, that's a good question, but also a very difficult question to talk about because it depends on the Chama. As I mentioned, it depends on the amount of money the Chama has. It depends on the time horizon for the Chama. It depends on the risk tolerance of the Chama. So historically, what I've seen Chamas do is they just take the money and they put it, I always say, in cooperative bank, and then they go buy a piece of land. And that worked for the last 2 decades. But then now, as we see the land prices not going up, the land prices are either stagnating or going down, then we'll start seeing how Chamas will start looking at things differently. What I usually tell Chamas to do is you actually have to come up with an investment policy statement. You have to look at your Chama and say, how much money am I coming with every month? Because most people are contributing either monthly or annually. And then come up with a policy statement whereby we can look at the diversity of different asset classes. Maybe you'll have some money in real estate. Maybe you'll have some money in unit trust. Maybe you'll have some money in the stocks. So it depends on that particular Chama or investment group, if I may put it. And so what I would say is for anyone to advise you where to invest, it depends on these different variables. So just speak to a wealth advisor and they'll be able to assist you. But if someone just tells you best investment for Chama is this, without even understanding the background, I don't think they are gonna give you the right kind of information. So just be aware about that. All right. So another question I have here is Karosh says, hi Anne, thanks for the wonderful presentation. You're welcome. If one got $500,000 now, what would be the best short-term investment option? Okay, short-term investment options for 500,000. So in the short term, what I usually recommend to people is either a money market fund or a fixed income type of product, right? Because then you can easily access it. So for example, you want to just put it in the next 6 months and the next year. So I would go ahead and say you want to put it into either money market or fixed income. Now, most of the fund managers or most investment managers, usually for you to put it into an investment that will give you double digit or a really good return, they usually require someone to have at least $1 million shillings, right? So that's most fund managers. There are some who are coming up who you can actually invest into a fund, which is not a money market, which is not locked, but then you can invest for less than 1 million. So what I would say, Caroline, is just reach out to us at Regal Africa. We'll go through a list of fund managers. We work with 8 licensed fund managers in Kenya. They are the best of the best. We've been doing research for the last 5 years. And then now we can be able to advise you accordingly based on the amount that you've told me, based on the fact that the time horizon is short term, and assuming your risk tolerance is I'll find out what your risk tolerance is before I can actually tell you what is the best thing for you to do. So Richard, so just contact us at Regal and we'll advise you accordingly. All right. I have more questions here on Facebook. It's let's see here. Anne, you're doing a great job. Thank you. This is Nyambura of Swans Green Limited Real Estate. I'm glad you're talking about traditional and alternative investments. Feel free to refer your real estate clients to me. Would love to work with you. Wow, okay, Nyambura, there goes a really good business person. So she's in real estate. So if any of you guys are interested in buying any kind of property, be now or in the future, reach us out to, contact me and I can connect you with Nyambura of Swan Green Limited. All right. So Miriam has another quick question. She says, when investing through asset managers, aside from their licensing by CMA or any other authority, what else should someone look at as due diligence? Okay. Aside from their licensing by CMA. So when I'm recommending my clients to invest with this asset managers, as licensing is one thing, because then you know that there's an authority that is overseeing this asset manager. So that at least gives you assurance that they are doing the right thing. But you need to go beyond that. What I always say is you have to look at management. Who are the people behind that company? Are they people of integrity? What have they done in the past? Are they shady? Are they good? Because even though they are licensed, there might be something about their background that would be a red flag. So you want to look at management. You also want to, again, look at their track record, how long they've been in the industry, even if it's not necessarily that fund. What is their track record? Because their track record will actually tell you if a fund manager is a good or not. And then just the environment in that company. So I'm very big on customer experience. You can always tell a company is good by how the employees are or how they treat you or the kind of service that you get, because happy employees give happy service. So if maybe this is a bit emotional, not emotional, but those are things you want to look at. You want to look at who's behind, who are the employees there, how is the working, because anything that gives you a red flag or tells you think twice, I wouldn't put my money with them. But so that's what I would definitely look at. But I will tell you this, with fund managers, the thing about it, it's not necessarily even about that particular company, because the company is just someone who is managing the funds. Usually what happens with asset managers is the assets are put with what is considered a custodian bank, right? So even if that fund manager goes out of business, the assets are still kept in custody with a custodian bank. So you don't lose your money. It's different, if for example, you put your money in the bank. And that's why I always tell people, be careful about the banks that you put your money in, right? So if you put your money in a bank and the bank goes down, right? Then, then you might lose your money, right? There might be some money that you can recover, or it might take a long time before you recover your money. But the thing about it is the money with that bank is being managed by that particular bank. So if the bank goes down, you can actually lose your money. But with a fund manager, because the money is not with the fund manager, the money is with a custodian bank, then there is security knowing that even if that fund manager is small or it goes down, then at least you'll be covered. Also with fund managers, they have what is considered a trustee. So a different independent body that is overseeing what this fund manager is doing. So with fund managers, they actually have different things to make sure that your money is safe. And that's why I recommend people to invest with fund managers. But again, doing your due diligence is very important. You have to know who's behind that company before you give them your money, and then it disappears. So due diligence is important, okay? And Louis says, this information was very useful. Thank you so much. You're welcome. Mima says, thanks, Anne, for great investment knowledge. You're welcome. And I wish you will be joining us every Wednesday, same time, 6 p.m. East African time and 8 a.m. in Pacific Standard Time. I am here to answer your questions, at least for now until the foreseeable future. And I always tell people, even if you think that situation is only about you, there's someone else who has the same question, but they just didn't know how to ask. So when you ask these questions, then I answer, somebody else is actually helped, or somebody else is actually blessed because you actually asked that question. So always join in, ask questions so that I can be able to help you and help other people. Kari Gobi says, great info, very informative. Thank you, and join us every Wednesday. Miriam says, thank you for responses. Well put. All right, I keep seeing different people coming in. So thank you for that. And I appreciate you taking the time to join me here at Wealth Conversations with Anne Gaitha. Like I said, I started this because I really wanted to help people. I've been getting many questions, and I just wanted a platform where I can answer these questions for everybody. This is something that I do because it's in my heart. I have actually experienced a lot being a banker, being in asset management, investment banking, dealt with the wealthy. I have insights that I believe I can share with you, at least on a high level, and it will then give you the direction to then now go in and do research or actually work with a wealth advisor who can actually help you with that. So thank you for joining in, and I will like to see you every Wednesday at 6 p.m. I see here Wandia says, well done, Anne, fantastic conversation. Thank you very much. I appreciate it, Wandia. Thank you for coming. Caroline Kadikini says, the time is very convenient. Thank you. I actually said 6 p.m. because I knew in Kenya, because of curfew, everybody's home. So you'll be in time to be part of this conversation. And Stella says, thank you. And thank you, Stella, for joining in. And I really appreciate all of you guys joining in. I will say that after this conversation ends in the next couple of minutes, if you're on Facebook, just start a watch party with your friends, start having this conversation. I think we need to move the conversation from just Corona, and we need to have meaningful and engaging conversation. So if this video will be able to help you start that conversation with your family, with your friends, with the community, go ahead and share it on Facebook, start a watch party. I really, really appreciate it. The last thing I want to say is, like I said, I always have this conversation every Wednesday at 6 p.m. East African time on the Facebook Live or on my page. there is a tab that you can just click, and you can always ask these questions. So you can ask these questions beforehand. So just as I'm going through the conversation, I can answer your question. Especially if you don't want others to know it is you asked that question, then go ahead and just send me a private question and I'll answer it without mentioning your name. The last thing I also want to say is that I just came up with a Workbook Ebook, which is just a workbook. So basically what this does is that you can actually just purchase it. It's only 1,000 Kenya shillings or $10. You go in and it actually helps you put together a wealth plan from understanding what assets you have, what liabilities, your income, your expenses, your insurance needs, your retirement needs, your estate planning, do you need a family company, a will, a trust. It's just a book that will help you take the time to note down everything that you need, and so that you're actually clear on where you are, so that when you start investing, then you know these are the steps that I need to take. So by the time you speak to a wealth advisor, a financial advisor, or any person who is helping you invest, you're very clear where you are and where you want to go. So with that, I'll say thank you very much for joining this wealth conversation with Gaitha. I really, really appreciate it. So thank you. Have a good day if you're in the US, and have a lovely evening if you're in Kenya, and God bless you. Thank you very much. See you next week.